how economics really works versus what you are told and what you learn. Okay. Where's the volume for this? Okay.
The asset this time was houses. The Federal Reserve had cut interest rates from 6% in 2001 to 1% in 2003. Rock bottom interest rates created a huge demand for mortgages, as they were cheaper to pay off. Everybody wanted a house, and that pushed prices up. You could get rich just by becoming a homeowner, as the price kept going up. Soon, even people who could not afford to make a down payment or could not provide proof of a steady income and collateral were given loans to purchase new homes. If these people defaulted on their payments, the bankers didn't care. They would be left with a house, an asset that was rising in price. These no down payment, no collateral mortgage loans, called subprime mortgages, were given to millions of low-income families.
If one of the barriers to home ownership is the inability to make a down payment, and if one of the goals is to increase home ownership, it makes sense to help people pay that down payment.
Now, the bankers had a brilliant idea. Bundle up the normal mortgages with the subprime ones and sell them to other banks, pension funds, hedge funds, and sovereign funds. Mortgage payments generated huge profits, and demand was high for this new type of speculative contract, now called collateralized debt obligations, or CDOs. This created the housing bubble.
Ben, there's been a lot of talk about a housing bubble, particularly, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates.
The experts appeared all over mainstream news, assuring everyone that housing was not a bubble.
Wealth has risen dramatically. The United States economy has never been better shape. There is no tax increase coming in the next couple of years. Monetary policy is spectacular.
The Federal Reserve now started to increase interest rates. By 2007, the interest rates had reached 5.25%, and many families with subprime mortgages could not afford to make the monthly payments, and their homes were foreclosed. As more and more houses went up for sale, the prices started dropping. Consumption plummeted. A new crisis had begun, and it would reach its peak in fall 2008, right before the elections. House prices tanked. Banks and other investment funds found that their bulletproof, high-profit CDOs became worthless. No one wanted to buy CDOs or houses anymore. It was a financial bloodbath. The banking giant, Lehman Brothers, had bet on mortgages and was left holding assets nobody wanted anymore. On the 15th of September, it filed for bankruptcy. During November 2008, Americans lost more than a quarter of their collective net worth.
2008.
U.S. stocks were down by 45% from its 2007 high.
Down by 45%.
Housing prices had dropped 20% from their 2006 peak. Total U.S. household wealth went down by $14 trillion. Through the banking giant Citicorp, Bank of America, J.P. Morgan, and Goldman Sachs, the big traders of CDOs, the crisis had spread to the world. And now, stocks and property values plummeted everywhere. The economy of the world entered a deep recession. All this happened as our nation was preparing to choose its 44th president. The housing bubble
That was
burst
Obama.
2 months before the election. So how does our theory stand? We had a new housing and subprime mortgage bubble created by low interest rates.
Next
Many
president was
Americans thought
Obama.
housing was a secure investment. The banks gambled huge sums of money on CDOs. The experts, again, said everything was fine. The economy started to weaken in late 2007 as the Fed was increasing
Economy
the interest
weakened
rates.
2007
The bubble
as the Fed
violently burst,
raises
just
interest
as
rates.
Americans were preparing to vote for the 44th president of the United States.
Economy begins to slow down,
Everything that
and the
happened
bubble
in
bursts
2000
before the next
happened
presidential
again in
election of Obama.
2008. The bubble burst in the year of the elections. Only this time, it was bigger, and the damage was global. and massive. The theory is proven correct again. There's an election coming this November. Will there be another economic crisis? Let's go through our checklist again. In December 2015, the Fed started to increase interest rates. For the past 5 years, the rate has been close to 0%. The economy is already showing signs of slowing down. Right now, the Bloomberg Commodity Index hit a 16-year low. The last time this happened was August 2008. Commodities represent all the goods being traded around the world. Everything from oil to coffee, sugar, steel, and copper. When their price slumps, it signals a slowdown in the world economy. Oil is reaching its 2008 low point.
Brent crude oil price
Last time the price
in
of
per
oil
barrel
was this
daily.
low, the global financial system was melting down. And this time, it will hit the U.S. economy much harder because of the shale miracle. CNBC's Jim Cramer is warning that many U.S. oil companies will become
CNBC
bankrupt if the price
Jim
of oil
Cramer.
remains
Look
this
him up.
low. The price of copper, too, has plunged all the way down to $2. The last time it was this low was just before the stock market crash of 2008. Consumption is slowing down. U.S. imports of
Consumption
goods
slowing down.
declined by 6.6% on a year-over-year basis. U.S. exports of goods declined by
So that's
10.4%
2015.
on a year-over-year basis. 2015 was the worst year for holiday spending since 2008. U.S. manufacturing is contracting at the fastest pace that we have seen since the last recession. If just one or two of these indicators were flashing red, that would be bad enough. The fact that all of them seem to be saying the exact same thing tells us that big trouble is ahead. So, what are the experts
What are
saying?
the experts saying?
What do you see right now? Actually, the economy is fundamentally strong. Housing is booming. Technology is booming. Commercial real estate is booming.
In all fairness to Obama, during his administration in the last few years, jobs have been created and the jobless rate is way down.
If you just kept it simple, you'd say that the United States is growing almost at kind of a trend growth. You know, whether it's 2.5 or just under 3% growth, or maybe even a little above it. We'll no, but around trend growth.
Following our checklist, we have an election year, the Fed raising interest rates, an economy slowing down, experts saying everything is fine. The only thing that's missing is the bubble that Trump warned will burst before the November elections. Does he know something we don't?
The word bubble, remember the word bubble, you heard it here first. I mean, I don't want to sound rude, but I hope if it explodes, it's going to be now rather than 2 months into another administration.
Well, to understand exactly what a bubble is, we need to look back at the dot-com and the mortgage CDO bubbles. In both cases, people thought that they had something that would never stop growing, something too big to fail. In both cases, stocks and housing attracted huge sums of money, driving their prices way beyond the actual value. This is just like gambling. Buyers get the asset, hoping they will sell it in the future for a profit. When the bubble bursts, those who are left with the asset suffer huge losses. Right now, I must ask you to give me your full attention. The following 5 minutes will be shocking and a little bit tricky to understand. And I hope you're sitting down for this.
You ready for
My
this?
prediction for 2016 is that we will see a banking collapse that will make the 2008 crisis look like a Sunday afternoon picnic.
So it'll be a massive
This
recession.
coming crash will wipe out the entire U.S. financial sector and take with it savings, deposits, retirement funds, pensions. It'll be nothing short of a financial bloodbath.
It's America.
How can this be possible? Well, remember how bubbles are created when something seems to grow indefinitely? The delusion is that something is too big to fail. But the bigger the bubble becomes, the faster it fails. Right now, people think big banks can't fail because of their size and importance in the world economy. It is as blatant as their name suggests. How did we get here? On September 18, 2008, Hank Paulson, the U.S. Secretary of the Treasury, told members of Congress that $5.5 trillion in wealth would disappear by 2 p.m. that day, unless the government took immediate action. What took place next was undoubtedly the biggest blackmail in history. The threat: keep the big banks alive, or else the economy implodes and depositors lose their money. In December 2008, the first of many financial stability measures was put into place. The Fed's mission from now on was to keep the big banks alive no matter what. Economists calculated that the total cost of the various measures put into place to accommodate big banks was in excess of $20 trillion up to this year. The too big to fail banks now had a taxpayer-sponsored safety net. The message was clear. Do whatever risky business you want. We've got your back. And this is how Congress and the Federal Reserve created the ultimate bubble, the too big to fail bubble. The idea that the too big to fails were going to get cut down to size after the financial crisis has turned into a giant myth. In fact, they've become even bigger. JP Morgan Chase, number one among banks in total assets, has seen its base swell to more than $2.5 trillion. The company's deposit base alone has grown by 29% since the end of 2008. The so-called Big Four institutions, JP Morgan, Bank of America, Citigroup, and Wells Fargo, continue to distance themselves from the pack with some $8.2 trillion in total assets. That's 154% more than the rest of the top 50 banks combined. Unfortunately, the old saying, the bigger they are, the harder they fall, will prove correct. And when they collapse, the result will be nothing short of catastrophic for the world economy. But for a bubble to
That's a
inflate,
tractor.
you also need an asset on which speculation, or rather gambling, has become so rampant and so over the top that a disaster is just waiting to happen. Let me introduce you to the world's biggest and most dangerous casino. It's called the derivatives market. And right now, the total net worth of all outstanding derivatives contracts is a staggering $552.9 trillion, according to the Bank for International Settlements. $552.9 trillion. Let that number sink in for a moment. Total U.S. debt right now stands close to $19 trillion. And most Americans find that shocking. But very few have any idea of how big this financial market is. The entire economy of the world, in real goods and services, is evaluated at around $78 trillion annually. The derivative market is 7 times the value of every good and every service provided around the world in an entire year. At first, I thought this number was too big to be real. But the Office of the Comptroller of the Currency, independent bureau of the U.S. Department of the Treasury, confirms it.
Okay, independent
Make no
bureau.
mistake, you are looking at the biggest bubble in the history of mankind. Something 7 times greater than the entire economy of the world. So what exactly is a derivative? A derivative is a speculative contract, a bet placed on stocks, mortgages, interest rates, the price of commodities like gold, silver, coffee, oil, or the possibility of a company or even a nation to default. Basically, right now, there is nothing of economic worth that does not have some sort of derivative attached to it.
Now you
All
know
derivatives are bets.
why this
This
gambling.
is not a metaphor, an analogy, or a generalization. The players on the derivative market gamble trillions on the future price of the asset to which the derivative is attached. These are the speculative contracts that will eventually pop the current gigantic bubble. Warren Buffett once referred to derivatives as financial weapons of mass destruction.
Warren
He was
Buffett.
proven right. The CDOs that led to the crash of 2008 were derivatives, as they drew their value from interest payments on mortgages and housing prices. They were traded on this market just like all the other derivatives, and they were just a tiny part of the market. In 2008, there were about $500 billion worth of CDOs. That was only a very tiny fraction of the derivatives market, yet it was enough to almost collapse the economy of the world. Remember how I said that this is the world's largest casino? In a nutshell, the derivatives market, or more correctly put, the derivatives casino, is where big banks and other financial institutions place their bets on every aspect of the world economy. Yet with these bets, everybody loses. So how did this bubble inflate to more than $550 trillion? Say Jack controls the derivative department of one of the too-big-to-fail banks. He knows that the riskier the bet, the higher the profit he gets, and the bigger his bonus. And he thinks, just like everyone else, that if he loses, the Federal Reserve will bail him out just like in 2008. What do you think Jack would do? How much do you think Jack would bet on derivatives? Well, the Office of the Comptroller of the Currency has
Office of
the
Control of
exact
Currency.
numbers. Citigroup, total assets more than $1.8 trillion. Total exposure to derivatives, more than $53 trillion. JP Morgan Chase, total assets about $2.4 trillion. Total exposure to derivatives, more than $51 trillion. Goldman Sachs, total assets less than $1 trillion. Total exposure to derivatives, more than $51 trillion. Bank of America, total assets a little bit more than $2.1 trillion. Total exposure to derivatives, more than $45 trillion. Morgan Stanley, total assets less than $1 trillion. Total exposure to derivatives, more than $31 trillion. Overall, the biggest U.S. banks collectively have more than $247 trillion of exposure to derivatives contracts. This is an amount of money that is more than 13 times the size of the U.S. national debt. And it's a ticking time bomb that could set off financial Armageddon at any moment. This is gambling on the future of the world economy on an unprecedented scale. And just like every other bubble before it, the too-big-to-fail derivatives bubble will burst. The bubble to end all bubbles, because of its sheer size. It's inflated to a size far greater than the dot-com bubble and the mortgage CDO bubble combined. This is the final piece of the puzzle. The Fed interest rate hike, the experts claiming everything is okay, the real economy slowing down, and the bubble that is inflated to an unsustainable size. If history repeats itself, 2016 will be the year big banks come crashing down, and the Fed and our government are totally powerless to stop them. Their safety net is made out of straws. It took extraordinary efforts to prop up the big banks in 2008. During Obama's presidency, the U.S. debt doubled, reaching almost $19 trillion. Yet the economy grew at a modest pace of 2% per year. Compare that to the doubling of the derivatives market, and you begin to realize the level of economic pain we are about to feel. This will make the Great Depression of the 30s and the Great Recession of 2008 feel like a picnic. So what would a crash look like? You need only to picture what happened in Greece to get an idea. The first thing that happened is that all the banks closed. The only way people could get their money out was with ATM withdrawals. And they were limited to 60 euros a day. That's about $63. Ask yourself this. If the banks close in the U.S., could you live with $63 per day? Immediately, huge lines formed in front of ATMs. People waited in the scorching heat for hours to get a tiny fraction of their savings and deposits out. 17% of the Greek population is currently unable to meet their daily needs for food. Approximately 30% are living below the poverty line. The official unemployment rate is 27%, 52% of under 25s. In Athens, Greece's capital, one of these is 53-year-old Athenian Vasilis Dimopoulos, who used to earn up to 3,000 euros per month until his employer folded in 2008. I sold my home in 2007, though the small profit I made is now gone. I was on the streets for 6 months, he said. Now, Dimopoulos lives in a Red Cross hostel selling Athens street paper, Shadia. Dionysia Michalidou, retiree. I have no insurance. I have no pension. I have nothing. Since the crisis, suicides have increased by roughly 50%. Emmy Christoulis, daughter of suicide victim. If one Greek was to take up a Kalashnikov, I would be the second. I find no other solution than that of a dignified exit before I begin searching through the garbage for my food. I believe that one day, because the younger generation has no future, they will take up arms and hang the traitors of the nation. Keep in mind that Greece received bailouts in 2015, and yet this is the situation there. Who will be able to bail out the world's largest economy? No one. The crisis brought by the collapse of the too-big-to-fail banks will be global, and it will dwarf anything the world has ever seen. Personally, I expect that everything that happened in Greece will happen in the U.S., but on a much greater scale, and the impacts will be far worse. I have studied economics for the past 35 years.
There you go. He's
I have
experienced
seen
in
the good
economics.
times,
35 years
and I have
experience
studied the bad ones.
in economics.
I went through the numbers over and over again, thinking this is not real, thinking I had made a mistake somewhere. But many other economic experts say the same thing. The same experts who warned us about the crisis coming in 2008 are all sounding the alarm bells. Peter Schiff, Gerald Celente,
Peter
Mark
Schiff,
Faber,
Gerald
and many
Celente,
others
Mark
are
Faber,
predicting a disaster.
and more.
The Federal Reserve has cut its key interest rate to the lowest level on record. Interest rates also fluctuate. Interest at banks
Prices will have the biggest fiscal stimulus we have ever seen.
And that'll solve the problem. We're in the midst of a serious financial crisis. The federal government is responding with decisive action. We lose confidence in money market.
There you go. The shocking truth. So, what these current economists are telling you is a massive lie. And what these suppressed economists are telling you is the truth. That we're in a bubble that's going to burst very soon. And no one will be able to be bailed out. Which means poverty. So, I hope this was helpful and gave educated you in some way. There's various different places you can search, like you've got Money News, you've got The Economist, Ireland, you've got various if you search YouTube you will find them. All you have to do is look up the truth about the economy, the truth about money, and you will find them, I promise you. And they're very reliable. Okay.